Hello everyone, this is Marco from LifeRoadsDataring.com and I'd like to welcome you to another video. Today I'm talking about the average daily range. The average daily range is a tool which gives you an idea about the current volatility in the market. It basically calculates the average daily ranges of the previous days and makes a projection of the possible daily range of the current day. This is a non-lagging indicator and you can find it in the internet, but maybe your trading station already has that implemented. If not, you can also calculate it by your own. If you want to know how to do this, feel free to check out my article I wrote about the average daily range. Here we have the Aussie dollar chart in a 1 hour time frame, and you see 5 different lines in my chart. These lines represent the different average daily range levels. The violet one is the opening price of the instrument. In that case, the opening price is 10723, and the indicator just projects the average daily range to the upside and to the downside. In this case, the average daily range is 84 pips, so this indicator draws an extreme line here to the upside, 84 pips to the upside, and also one extreme here, 84 pips to the downside. It also draws halfway between the opening and the extremes another line. Of course, if the price, like in that case, touches halfway down here and then goes halfway up, these two lines are also 84 pips away. So that range is also 84 pips, and if we see a touch of that level and then the price goes through the opening price and touches halfway to the upside here, then we expect we will not see any further movement to the upside, at least not much movement, because the Aussie dollar in that case already moved its average daily range. You can use the average daily range in many ways for your trading. They are basically support and resistance levels, and you can take counter trend trades at these levels. I prefer to trade with a trend, and I use them as targets only. But you can also build your own strategies with that average daily range. I will show you a strategy on how to use the average daily range for your trading. Actually, it's a system, it's very easy to duplicate. It's quite effective in a trending market, but it's also doing okay in a sideways market. You will most likely ending up with a small loss in a sideways market and with a nice profit in a trending market. First of all, we have to identify the trend. I don't want to use any more indicators here or draw any lines or use a moving average. I will just use the average daily range levels to identify the trend. The simple rule is, if the average daily range lines moving down, we go short. If they're moving up, we go long. In this case, they moved down from the day before, so we place a short order right at the open of the day. The stop in that case is placed 10 pips behind the average daily range level 1, and the first target is the average daily range level -1. Second target is the average daily range level -2. So we go short here, target gets hit, and we take off half of our position. Since this is a sideways day, as you can see, the price moves up and our second half of our position is getting stopped out at that level here. So net we ending up with a small loss. We made profit with our first half of our position and lost a bit more on the second half of our position. But I think for trending strategies, that's okay in a sideways market. One more thing, this strategy is especially good if you don't have much time during the day to trade. You can place your limit orders and your stop orders at the open of the day. You know your levels, you know your stop levels, you know your target levels, minutes in front of the day. So if you don't want to spend the whole day in front of your computer, that's really a good strategy to trade with a trend. Also, you have to like the logic behind this. If we get to the target here, to the first target, we know the average daily range is in that case 84 pips up here, so we can assume our stop is safe. It has been taken out, but we use the statistical advantage at our side, so in most cases we will not getting stopped out here. Here we have the chart of the pound versus the dollar at the 1 hour time frame, and I want to show you how the strategy works over a longer period of time. Let's start here on the left side. As you can see, the lines are moving to the upside, so we're only taking long trades at the open. First trade here placed long, target got hit and we stopped out here for the second position. Next day we go long again at the open, target got hit, so we are keeping half of our position through the next day. The second target didn't get hit on this day here, so we keep the position and just open another half position here. So again our target got hit, we close half position, we still keep a half position. We open another half position here, again long trade, and both half positions got stopped out here. With this down move, also our lines moving down, so we have to look for short trades here. We get in here, short trade, first target got hit, we take out half of our position, and also the second target got hit on this day here. New short trade here, target got hit, the first target, our second target didn't get hit, so we keep half of our position. We open a new half position here, and target got hit here. We take out half of our position. Our line still moving down here, so we have still a half position. We open a new half position here. Neither of our targets got hit, also no stop. And as the lines moving up here with the next day, we close our short position and reverse it here, taking a long position, taking off half here, target get hit, new long position, but only a half since we still keep the other half, taking half out here, stop didn't get hit here, but since our lines moving down on that day, we close that half position from that day and open a new short position. Again, taking out half here of the short position, and on that day, it's a sideways day, the second short position got stopped out here. New long position here, half of our position gets out here. We keep that half position and adding another half position here. Target got hit or for our first half and also for our second half. So we have a completely new long position here, taking off half here and then adding another half at that point, and both getting stopped out at that point here. I have to scroll here a bit. On the next day you can argue that we are still in an uptrend, even the lines are pointing down, but since we use the simple rule, we have to go short here since the lines are pointing down, and the trade is stopped out at that point here. again, also on the next day we have to go long, since the lines are pointing up and the trade is also stopped out down here. Then we have to go short since the lines are pointing down again, so we're in a sideways market now. And we also produce losers, but in this case the first target got hit and also the second target. We have to go short again. Trade would have been stopped out here. Long, and I guess the trade didn't get stopped out here since these are not 10 pips behind the line, but we have to reverse the position then here on that day because the lines are pointing down. So also small loss here, and target gets hit, next target also gets hit. We have to go short and we are getting stopped out here. So this whole period is a sideways market, so we produce a bit more losers than winners, but as we enter a trending market again here, we go long and both targets getting hit, and also on the next day both targets getting hit. I will summarize things here. The ADR is the average daily range over the previous days. We expect that the range of the current day will not be much larger or lesser than the average daily range. The average daily range levels can be used for trading in a trending market or in a sideways market. They can be used as entry, target or stop levels. The previously shown strategy works great in a trending market, but sometimes produces more losers than winners in a sideways market. The strategy can also be refined by your own for better results. Ways to define the trend is up to you. The strategy is specially designed for people who don't want to be in front of the computer the whole time. Stop and target levels are defined at the beginning of each day. I will go now over the clear rules we have by using the strategy I have shown you. We open a long position at the beginning of the day if the average daily range line is pointing up, or open a short position if the average daily range line is pointing down. We put the stop loss 10 pips behind the average daily range level -1 for long position and 10 pips behind the average daily range level 1 for short position. And we close half of the long position at the average daily range level 1 and the second half at the average daily range level 2. On the other hand, we close half of the short position at the average daily range level -1 and the second half at the average daily range level -2. If only one target level gets hit, keep that half position to the next day and add another half position if the trend is intact, or reverse the position if the trend changes. This is just one way to use the average daily range levels. It's very easy to duplicate, and if you like that video, feel free to check out my other videos at liveforexdaytrading.com. Have a great day. Bye.